Here is a question that short-circuits how most people think about money. The Federal Reserve manufactures dollars trillions at a time. They come from nowhere, just digits keyed into a ledger. No gold stands behind them. No outside asset is pledged. No depositor puts up funds first. They are willed into existence. In 2020 and 2021, the Fed created approximately $6 trillion, or $6 trillion conjured from thin air. It wasn't mined. It wasn't earned. It wasn't borrowed from anyone. It was typed into a computer, and it appeared. Now the snag. Every paper bill reads Federal Reserve Note. A note is a debt claim, a formal promise to pay. When you sign a promissory note for a car loan, you are acknowledging a debt. A note equals a liability. That means every dollar in circulation is, strictly speaking, a debt instrument. Someone owes that dollar to someone else. If the Fed can bring dollars into being out of nothing, and those dollars are notes, debt, then who is the creditor? If the dollars had no lender to begin with, no one who fronted the money, who is on the other side of the obligation. If dollars are IOUs and the Fed issued them, whom exactly does the Fed owe? The answer should be obvious, but it isn't. Once you see the machinery, you realize the setup routes wealth away from you and toward private banks. The Federal Reserve does not owe the dollars to anyone. The United States government, however, owes money to the Federal Reserve, and the reserve system is owned by private banks. That means your government borrows funds fabricated from nothing and pays interest on them indefinitely to private banking interests. You fund that interest with your taxes. It is a century-long scheme hidden in daylight, and most people never notice it. This is the real story of how dollars are created, who sits behind the Federal Reserve, and why the national debt cannot be retired, because if it ever were, the money stock would vanish. The design requires constant debt and unending interest payments from the public to private banks. Before answering the owed to whom question, you have to know what the Federal Reserve actually is. Much of the conventional picture is wrong. Most Americans assume the Fed is a government bureau, like the Treasury or the IRS. It is not. The Federal Reserve is a private banking cartel. It was established by the Federal Reserve Act of 1913, and it was structured by bankers, for bankers, to give them control over the money supply. The system has 12 regional Federal Reserve, Banks New York, Chicago, San Francisco, Philadelphia, Boston, and 7 others. Each of those 12 is a private corporation, not a government agency, private firms with shareholders. And those shareholders are private commercial banks. J.P. Morgan Chase owns stock in the Federal Reserve Bank of New York. So do Citibank, Bank of America, Goldman Sachs, Morgan Stanley, and other giants. The largest institutions in the country are literally shareholders in the regional feds. They own them. There is also a board of governors in Washington, 7 members appointed by the president and confirmed by the Senate. That structure creates the impression of government control, but it is largely theatrical. The board sets high-level policy. The regional Federal Reserve banks private corporations do the work. They hold assets, interface with commercial banks, operate the key systems, and execute the transactions. And those operating banks are owned by private banks. Here is how membership works. Any commercial bank in the Federal Reserve System, including the behemoths, must buy shares in its regional Federal Reserve Bank. A New York-based bank like J.P. Morgan Chase holds stock in the Federal Reserve Bank of New York. Those shares pay a statutory dividend, 6% annually guaranteed, and essentially risk-free. Regardless of the broader economy, member banks receive that payout on their Fed stock. That obligation is written into law. By law, the Federal Reserve pays member banks a dividend, since 2015 for the largest members up to 6% or the 10-year Treasury yield, whichever is lower, before any residual profits are remitted to the Treasury. In short, the Federal Reserve is a profit-making enterprise owned by private banks that pays those banks dividends and also holds the legal authority to create unlimited dollars. A private syndicate holds the money creation lever and charges the government interest on the liabilities it issues. Why would the government give private banks the power to create money? That is the essence of the arrangement. In 1913, the dominant banking houses J.P. Morgan Circle, Rockefeller interests. Rothschild-linked capital pushed Congress to pass the Federal Reserve Act. The pitch was stabilization and run prevention, particularly in the wake of the 1907 panic. The deeper aim was control over the money supply. Control the money, control the economy, influence the state. Before 1913, the federal government could create money directly. After 1913, it borrowed from the Federal Reserve, a private cartel. Power to issue currency migrated from the state to private banks. It was the largest transfer of power in U.S. history, and most citizens never learned that it happened. So, how does the Fed actually create dollars? The steps are technical but clear. Step 1, the U.S. government needs funds. Suppose Congress passes a budget requiring $5 trillion this year, but tax receipts total only $3 trillion. There is a $2 trillion shortfall. Step 2, the Treasury issues bonds, IOUs promising repayment with interest. It auctions $2 trillion in treasuries to whoever will buy. Buyers include foreign governments, pension funds, mutual funds, banks, and the Federal Reserve. Step 3, the Federal Reserve chooses to buy, for example, $500 billion of those bonds via open market operations. Where does the Fed get the $500 billion? It does not collect it from taxes, deposits, or prior profits. It simply creates the balance. Operationally, the Fed credits the relevant account adding $500 billion to the Treasury's account on its books. No gold moves. No asset is handed over. No depositor parts with cash. The dollars are written into being by keystroke. Who owns the Federal Reserve? This is not a rumor. It is documented. The Federal Reserve Bank of New York. The system's most powerful regional bank, because it conducts the open market operations, is owned by its member banks. Large stakeholders include J.P. Morgan Chase, Citibank, Goldman Sachs, Morgan Stanley, Bank of America, and a small group of peers. These institutions are not just customers, they are owners, and ownership brings influence. Each regional Federal Reserve Bank has a 9-person board, 6 directors chosen by member banks and 3 appointed by the Board of Governors. Private banks therefore elect 2/3 of the directors of their regional reserve bank. Those directors choose the regional president, and the regional presidents sit on the Federal Open Market Committee, the FOMC, the body that sets monetary policy. Private banks thus have a direct channel of influence over policy through leadership they help select. The design loops influence back to the banks while preserving a facade of public oversight. The ownership picture is deliberately opaque. The Fed does not publish a ranked shareholder list with share counts. Yet relative size and board representation make the power distribution obvious. The biggest banks dominate and they profit. By statute, member banks receive their dividend before any remittance goes to Treasury. In 2023, the Fed recorded around $58 billion in profit. Member banks received roughly $2 billion in dividends. The Fed then sent about $56 billion to the Treasury. Notice where the profit originated. Interest on bonds the Fed holds. Bonds purchased with money created from nothing. The Fed manufactures dollars, buys government debt, collects interest, pays its costs and dividends first, and sends the remainder to Treasury. It is profit on money that costs nothing to originate. Meanwhile, the government and therefore taxpayers owes interest on that debt indefinitely. Follow the flow to see how wealth moves from taxpayers to the banking sector. The Fed creates $500 billion at zero cost. It buys Treasury bonds with those dollars. The government now has $500 billion to spend into the economy. Wages get paid, contracts get fulfilled, the machine turns. But the government owes the $500 billion plus interest, say, 3%, or $15 billion per year on that block alone. Where does the government get that $15 billion? Taxes, income tax, payroll tax, corporate tax. Every year, more than $1 trillion of federal revenue goes to interest on the national debt funds that could otherwise support infrastructure, healthcare, or education. A significant portion of those interest payments flow to the Fed. In 2023, the Fed held roughly $5 trillion in treasuries. With an average coupon near 2 to 3%, that produces about $150 billion of interest income annually. From that income, the Fed covers operating expenses, around $5 billion, pays the statutory dividend, around $2 billion, retains a bit as surplus, and remits the remainder to Treasury, around $56 billion that year. The The simplified arithmetic is illustrative. Enormous interest streams arise from money that costs the Fed nothing to create, and those streams are funded by your taxes. You work and earn, taxes are collected, Treasury pays interest to the Fed and its member banks receive their cut. The pipeline moves your earnings through the state to the central bank and onward to private banks. That is the transfer. Now, the claim that upends conventional thinking: the national debt cannot be retired, not simply because of political dysfunction or overspending, but because the monetary framework itself requires permanent debt. Consider the logic. Every dollar in existence was brought into being when the Fed purchased debt, mostly government debt. When the Fed buys a Treasury bond, it creates dollars. Those dollars enter circulation. Therefore, each outstanding dollar corresponds to a debt liability to the Fed. If you add up all circulating dollars, you are tallying the debt that produced them. Imagine the government tried to pay down the entire national debt. It would collect dollars via taxes or other receipts and hand them back to the Fed to retire bonds. When the Fed receives dollars in payment, it cancels the bonds and extinguishes the dollars. The creation process runs in reverse. The money supply shrinks by the exact amount of debt retired. If the entire debt were retired, the dollars created against it would disappear. The circulating money stock would collapse to zero. No payrolls, no purchases, no bank balances. Commerce would halt. This is why the national debt has marched upward virtually every year since 1913, apart from a short window in the 1830s before the Fed existed. The debt cannot meaningfully shrink because the money supply itself would contract. As the economy grows, more dollars are needed. Within this design, the only way to create more dollars is for the government to borrow more, producing more debt. Continually rising debt is not a bug, it is the feature. There is an additional trap. The interest owed is not created along with the principal. Suppose the Fed creates $500 billion. The government now owes $500 billion plus 3%, annually $15 billion a year. Only the $500 billion principal was created. The $15 billion was not. It must be paid from dollars already in circulation, which means someone else must go into debt to create those dollars, or the government must borrow still more, which adds interest and compounds the shortfall. It is a feedback loop. If the liability after a year is $515 billion, but only $500 billion was created, there is a $15 billion gap. Filling the gap requires new debt, which carries its own interest, widening the gap. The debt pile grows faster than the money stock, because interest is not issued with principal. That is how the national debt reaches about $36 trillion and rises by roughly $2 trillion per year, even as tax receipts approach $5 trillion. The numbers do not reconcile. They are not designed to. The system manufactures unpayable debt that spins off perpetual interest income. Every dollar of interest paid is a transfer of wealth from taxpayers to the Federal Reserve and, by extension, to the banks behind it. A handful of presidents grasped the structure and tried to counter it. The outcomes were grim. In 1835, Andrew Jackson paid off the national debt, the only president ever to do so. He refused to renew the charter of the Second Bank of the United States, the central bank of the time, denouncing it as corrupt. He vetoed recharter, the bank dissolved, and drawing on tariffs and land sales, Jackson eliminated the federal debt for a brief interval. What followed was the Panic of 1837, a severe depression. With no new debt being created, the money supply contracted and the economy cracked. Jackson's case illustrated this. In a debt-based system, erasing debt erases money. In 1963, John F. Kennedy signed Executive Order 110, authorizing the Treasury to issue silver-backed certificates currency, bypassing the Fed. The aim was to restore a channel for direct government issuance dollars created without borrowing from the Fed. Approximately $4 billion in United States notes were printed, labeled United States Note rather than Federal Reserve Note, money issued by the government itself. 5 months later, Kennedy was assassinated. Lyndon Johnson took office and promptly halted the issue of United States notes. The new notes were withdrawn from circulation, and the system returned to exclusive reliance on Federal Reserve notes. Other presidents who questioned private control over money also met violent ends. Abraham Lincoln issued greenbacks government-created, debt-free currency during the Civil War. he was assassinated. James Garfield warned that private control of the money supply meant private control of the nation. He too was assassinated within months. The pattern is stark. Challenges to centralized banking power coincided with dire outcomes, and the Federal Reserve's model endured. Now, return to the opening riddle. If the Fed creates money from nothing, whom does it owe? The answer is no one. The Fed is the source of dollars. There is no lender on the other side. The U.S. government, however, owes the Fed. That is the twist. The Fed creates dollars by buying government bonds. In purchasing a Treasury, it creates the dollars used for payment. The government receives the balances, but now owes principal plus interest to the Fed, and the Federal Reserve is owned by private banks. Follow the chain. A privately owned central bank manufactures dollars from thin air and lends them to the government. The government owes the Fed. The government services the debt using tax revenue. Your taxes pay interest to a private banking cartel on money produced from nothing. The Fed owes no one. Everyone owes the Fed. Each bill is a Federal Reserve note, a formal debt claim. What you hold is proof of a liability the government has to private banking interests. That liability cannot be fully discharged because if it were, the money supply would vanish. The framework requires permanent, compounding debt that generates permanent interest, transferring wealth from taxpayers to banks for more than a century. Since 1913, the machine has run continuously. Trillions have been routed from the public to the banking system through this mechanism. Most people still believe the government prints money. It does not. A private banking cartel creates the currency and charges the government interest without end. The national debt sits near $36 trillion. It will not be paid off. It will grow because the design requires it. And each year, more than $1 trillion of tax revenue services interest on that debt interest that flows to the Federal Reserve and the private banks behind it. The question, who does the Fed owe, reveals the blueprint. It owes no one. It creates the money you owe, your government owes, and you cover the bill through taxation. The Federal Reserve Act of 1913 transferred the money creation franchise from the state to private banks and granted those banks a legal entitlement to profit from that power forever. Understanding the Federal Reserve is understanding who actually governs American finance. It is not the president. It is not Congress. It is the banking interests that own the levers. They hold the printer. They create the units. They collect the interest. And the public services, the obligation. The deeper question is ownership and control, and the answer keeps circling back to the same institutions that dominated credit before 2008, that were stabilized with trillions in emergency programs, and that profit from each new dollar of federal debt. They own the framework, and the framework is built to move wealth indefinitely from you to them. In practice, that control runs through the 12 regional reserve banks, whose stock is held by member banks, and whose board's 9 directors each are chosen 2/3 by those same members, with the remaining third appointed in Washington. Those boards select regional presidents who sit on the FOMC, the body that authorizes the purchases of Treasury securities that generate new base money. When the Fed buys a bond, it credits accounts with balances created at zero cost, books the bond as an interest-earning asset, and places itself ahead of taxpayers in the cash flow waterfall. Operating costs first, statutory dividends to member banks up to 6% or the 10-year yield. Only then, residual remittances to Treasury. The government, meanwhile, owes principal plus coupon on the bonds it sold, so the budget's interest line, now over $1 trillion annually, channels tax revenue back to the institution that issued the money against that debt. Because every dollar enters via a liability, retiring the debt retires the dollars created against it. Shrinking the stock of debt shrinks the money supply. The result is a self-reinforcing loop. Deficits produce new treasuries. The Fed converts a portion of those IOUs into dollars. Interest accrues to the Fed and its owners. Taxes service the stream, and any attempt to materially reduce the aggregate obligation collides with the fact that money and debt are two sides of the same ledger in this design. With a national debt near $36 trillion, a coupon burden that grows as rates rise, and member bank claims paid before the public's remittance is booked, the incentives never point toward extinguishment. They point toward rollover, expansion, and the preservation of a structure in which governance appears public, but the decisive economics issuance, ownership, and interest remain in private hands.